There is a number attached to your name. You did not choose it. You cannot fully see it. You cannot fully control it. And yet, that number, a 3-digit figure generated by a private algorithm, determines your access to housing, to transportation, to credit, to business capital, and in some cases to employment itself. You were told this number reflects your trustworthiness, your financial responsibility, your character with money. The implication is moral. A high score means you are a good person with money. A low score suggests the opposite. What it actually reflects is something far more specific and far more profitable for the institutions that created and maintain it. Today, we are going to pull back the curtain on that system. Not to make you angry, though some of this may do that, but to make you fluent. Because the system operates whether or not you understand it. The only question is whether it operates on you or whether you navigate it with intention. Let us start at the beginning. The credit score as product. The credit scoring system was not built to serve consumers. It was built to serve lenders. That sentence is not cynicism. It is history. Before standardized scoring, lending decisions were made locally, manually, and it must be said often discriminatorily. A loan officer knew the neighborhood, knew the family, made judgments based on personal familiarity that could just as easily encode racial bias as legitimate financial assessment. The system was inefficient and unjust in ways that hurt millions of people. The credit score was, in its original conception, a genuine reform. It removed the most visible and pernicious forms of personal discrimination by replacing human judgment with algorithmic measurement. If the number says you are creditworthy regardless of your name, your neighborhood, or who you know at the local branch. But reforms become systems, and systems develop interests of their own. The bureau business model. The 3 major credit bureaus, Equifax, Experian, and TransUnion, are not government agencies. They are private companies, and they operate with the profit motive of private companies. Understanding their business model explains most of what is otherwise confusing about the system. Their product is data. Your financial behavior, every credit account you open, every payment you make or miss, every inquiry generated when you apply for anything, is collected, compiled, and packaged into a risk profile. That profile is then sold to banks, mortgage lenders, auto finance companies, insurers, employers, and landlords who pay for access to it. You generate the data. You have no ownership of it. You receive no compensation for it. And the profile that is built from it and sold shapes nearly every major financial decision made about you, often without your knowledge. The consumer, in this relationship, is not the customer. The consumer is the raw material, the black box score. The score itself is a black box with deliberate opacity. The exact weighting of variables within the Fusho model, the most widely used scoring system, is proprietary. Fair Isaac Corporation treats the precise algorithm as a trade secret. You can know the general categories, you cannot know the exact formula. It gets more complicated. The 3 bureaus each use their own internal variations of the scoring model. Your Equifax score may differ from your Experian score, may differ from your TransUnion score, sometimes by 20 to 30 points, because each bureau may have slightly different data on file, and each may apply slightly different weightings. And even within a single bureau, multiple versions of your score exist simultaneously. There is the score you see when you check your credit. There is the score a mortgage lender sees using an older FICO model version that mortgage lenders are required to use. There is the score an auto lender sees using a model optimized for predicting auto loan defaults. There is the score a credit card issuer sees. These versions can differ meaningfully, and the version you have access to as a consumer is not necessarily the version the lender is using to make their decision about you. This is not an accident of poor design. It is a feature of a system built to serve multiple buyers with different needs, and to maintain the proprietary value of the scoring methodology itself. The behaviors that serve the system. The credit scoring system is not neutral. It was built by an industry to serve an industry, and the behaviors it rewards reflect that origin. Let us go through the major scoring factors, not just what they are, but what they actually incentivize, and who benefits. Payment history, 35% of your score. Payment history is the largest single factor in your credit score. Pay on time, your score is rewarded. Miss a payment, your score is penalized significantly. A single missed payment can drop a good score by 50 to 100 points and remain on your report for 7 years. This seems unambiguously fair, and largely, it is. Payment reliability is a legitimate measure of credit risk. But consider the asymmetry. The upside of perfect payment history accrues slowly, over years of consistent behavior. The downside of a single missed payment arrives immediately and persists for nearly a decade. The measurement is calibrated to make the cost of any disruption medical emergency, job loss, unexpected expense catastrophic and long-lasting. The lender's interest in predictability is protected. The consumer's vulnerability to life events is penalized. Credit utilization, 30% of your score credit. Utilization is the ratio of your current credit card balances to your total available credit. Use 30% or less of your available credit, and the score is happy. Zero utilization using no revolving credit at all, paying everything off every month in full, is counterintuitively not the optimal strategy for the highest possible score. The system rewards carrying a small balance. 1 to 10% utilization tends to produce the highest scores. The logic from the Bureau's perspective is that someone using no revolving credit is providing less data about their behavior, less signal. But the practical effect is that the scoring system gently, structurally, rewards the behavior of owing money. Not defaulting, not overextending, just perpetually maintaining a small balance. A small balance on which interest is being paid. To a lender, every month. Credit mix, 10% of your score credit mix, rewards having multiple types of debt simultaneously. A mortgage, an auto loan, a credit card, a personal loan, a student loan. The ideal credit profile, as measured by the scoring system, is someone actively engaged with multiple credit products at once. From a data science perspective, this makes some sense. A person who has successfully managed multiple types of credit across different term structures has demonstrated a broader range of financial behaviors. But the practical effect is that clean finances, no debt, no credit products, score worse than complex ones. The system is not measuring financial health, it is measuring financial engagement with the credit industry. Length of credit history, 15% of your score. The longer your accounts have been open, the better for your score. The age of your oldest account, the age of your newest account, and the average age of all accounts are all factors. This creates a perverse incentive. Closing old accounts, even accounts you no longer use. Even accounts with annual fees can harm your score by shortening your average account age. Consumers are therefore incentivized to maintain open credit accounts indefinitely, potentially paying annual fees on cards they do not use, simply to preserve the account age metric. The credit card company continues earning the annual fee. The consumer's score remains intact. The alignment of those interests is not coincidental. The system is not designed to identify who is financially healthy. It is designed to identify who is a profitable and reliable credit customer. These are related categories. They are not identical ones. The error problem. The credit scoring system's errors are not edge cases. They are endemic. A study conducted by the Federal Trade Commission, the agency responsible for consumer protection in the United States, found that approximately 1 in 5 Americans has a material error on at least one of their 3 credit reports. An error significant enough to affect their score, significant enough to affect the interest rate they are offered on a mortgage, significant enough, in some cases, to result in a denial of housing, credit, or employment. 1 in 5. That is not a rounding error. That is a systemic failure rate that, in almost any other consumer-facing industry, would trigger regulatory intervention. How errors happen. The credit reporting system relies on lenders, banks, credit card companies, auto finance companies to self-report consumer data to the bureaus. There is no independent verification of what lenders report. If a lender reports a missed payment that did not occur, the bureau records it. If a debt collector reports a collection account for a debt that was already settled, the bureau records it. If an account belonging to a person with a similar name is mixed into your file, a phenomenon called a mixed file, the bureau records it. Identity theft creates an entire category of errors. Fraudulent accounts opened in your name. Fraudulent inquiries generated in your name. Sometimes an entirely fraudulent credit history overlaid on your actual one. The Bureau does not know, at the point of data receipt, that the information is fraudulent. It processes and records what it receives. The dispute process, designed for whom? When you discover an error on your credit report, the law gives you the right to dispute it. The Bureau is required to investigate and respond within 30 days. This sounds like a reasonable system. The practice is significantly less so. Disputes are frequently evaluated by automated systems software that matches data fields against the original report from the lender. If the lender's record matches what the Bureau has on file, the automated system often confirms the original data as accurate and closes the dispute. The fact that the original data was wrong, that the lender's system itself contains an error, is not caught by a process that compares two copies of the same incorrect record. When human review occurs, the reviewers are often overseas contractors, working under significant time pressure, handling hundreds of disputes per day. The investigation that the law requires a genuine, substantive review of the facts is in practice often a speed-optimized administrative process. The burden of proof sits with the consumer. You must produce evidence that the error is incorrect. The lender, who reported incorrect information, faces no immediate burden. The Bureau, which recorded and acted on that information, faces no immediate liability. The asymmetry of burden mirrors the asymmetry of the business relationship. The lender is the Bureau's customer. You are not. And because errors do not cost the Bureaus anything, they generate no liability, no refund, no fine. In most cases, there is limited institutional incentive to invest in the kind of error prevention infrastructure that would reduce their frequency. The cost of errors is externalized entirely onto the consumers who experience them. Playing the system, deliberately understanding how the system is designed, allows you to work within it deliberately rather than accidentally. This is not manipulation. It is literacy applied to a system that has been operating on you regardless of your understanding of it. Let us go through the specific mechanics, the ones that have the largest practical impact on your score and on the cost of capital you access. Utilization timing. This is the single most actionable short-term lever most people have over their credit score, and most people do not know it exists. Credit bureaus receive your balance information at a specific point in your billing cycle, the statement closing date, not the payment due date. The balance reported is the balance on the day your statement closes, regardless of what you pay afterward. If your statement closes with a $5,000 balance and you then pay it in full before the due date, you have paid no interest, but the Bureau saw and recorded a $5,000 balance. Your utilization reflects that. The correction: pay your balance down before your statement closing date, not just before your payment due date. If you do this, the statement closes with a near zero balance. That near zero balance is what gets reported to the Bureau. Your utilization drops. Your score improves often significantly, often within a single billing cycle, without any change in your actual financial behavior. Account age preservation. Never close old accounts unnecessarily. This is not intuitive. A card sitting in a drawer with no activity feels like clutter, and the instinct is often to clean up the account roster by closing what you do not use. Do not do this. Every open account contributes to two metrics: the age of your oldest account and the average age of all accounts. Both matter. Closing an account, even an old one, even one with a small credit limit, removes it from your active account roster and can meaningfully shorten your average account age. If that account was your oldest, the impact on your history length can be significant. If the account has an annual fee that is genuinely not worth paying, call the issuer first and ask to downgrade to a no-fee version of the card rather than closing the account entirely. Most major issuers have product change options that preserve the account age while eliminating the fee. This is a straightforward call, one you can make in 5 minutes, that can protect years of credit history. Monitoring all 3 reports. Most consumers who check their credit check one report. The lender who evaluates their application may be using a different bureau than the one they checked. The error may be on the bureau they did not check. All 3 bureaus are legally required to provide you with a free credit report once per year through annualcreditreport.com, the federally mandated channel. This is not optional for the bureaus. This is your legal right. Use it. Stagger your requests, pull one bureau every 4 months, so you have a continuous monitoring cadence across all 3 throughout the year, rather than seeing all 3 once and then nothing for 12 months. When you review each report, check the following specifically. Account ownership. Are all listed accounts actually yours? Payment history. Does every payment listed match your records? Addresses and personal information errors in name or address can sometimes indicate mixed files or identity issues. Negative items. Check the dates on any negative items. Most must be removed after 7 years. And collection accounts sometimes remain listed past their legal expiry. Strategic credit building. If your score is low, below 600, or if you have limited credit history, the path to building it is specific and can move faster than most people expect if approached with deliberate sequencing. A secured credit card is often the most accessible entry point. You deposit a fixed amount as collateral, which becomes your credit limit, and the card reports to the bureaus as a standard revolving account. Used correctly, a small, recurring charge each month, paid in full, before the statement date, it begins building a payment history immediately. After 6 to 12 months of clean payment history, many issuers will convert a secured card to an unsecured one, returning the deposit and often increasing the limit. The account age carries forward. The history carries forward. The starting point was $70 in a secured deposit. The outcome is a credit account with a growing history and a recoverable limit. Credit builder loans, offered by many credit unions and community development financial institutions, work similarly. You make monthly payments toward a loan that is held in escrow and released to you at the end of the term. The payment history is reported monthly. The cost is modest. The credit benefit can be significant. Understanding hard versus soft inquiries. Every time you apply for credit, a card, a loan, a mortgage, the lender pulls your credit report. This is called a hard inquiry, and it temporarily reduces your score by a small amount, typically 5 to 10 points, and remains on your report for 2 years, though its scoring impact fades significantly after 12 months. Checking your own credit, being pre-screened for offers, and certain background checks generate soft inquiries, which do not affect your score at all. The practical implication: do not apply for multiple credit products in a short window unless you are rate shopping for a mortgage or auto loan, in which case the bureaus treat multiple inquiries within a 14 to 45-day window as a single inquiry, recognizing the consumer is comparison shopping rather than accumulating debt. Apply for one thing at a time, outside of that specific mortgage or auto context, and space applications by at least 6 months when possible. The credit scoring system is not going away. It is expanding. Insurance companies in most states are legally permitted to use credit-based insurance scores derived from your credit data to set your premiums for home and auto insurance. Landlords use it as a standard filter in rental applications. Employers in many industries run credit checks as part of background screening. The algorithmic judgment that began as a tool for evaluating loan risk has extended into nearly every area of financial life. And the direction of travel is toward more data, not less. Alternative credit scoring models which incorporate utility payment history, rent payment history, subscription services, and other non-traditional data are being developed and deployed. The credit footprint is widening. The system is deepening its reach into domains that did not previously require credit history. None of this is reason for fatalism. It is reason for engagement. The only productive response to a system you did not design and cannot dismantle is to understand it deeply enough to navigate it with intention, to know who built it and why, to know what it rewards and what that reveals about the interests behind it, and to apply that knowledge consistently, over time, in the decisions that compound. The banks designed this game. The bureaus operate it. The score is their product. Knowing that changes how you play. Your credit score is not your financial character. It is a commercial product built to serve lenders. The sooner you know that, the better you can play.